Hi everyone, hope you're doing well. Today I'm going to talk about the 3 stocks that I have been buying. I bought these stocks last week and I'll spend a minute or two on them talking about why I'm buying these stocks. They're all positions that I currently own already, so I was just averaging into them positions. The video won't be a full deep dive into these companies just because it would be too long, but I think I've got a full video on all of these stocks that I'm going to talk about in a second. On a little bit of a side topic, at the moment the likes on the videos are down massively. We normally get around 200 likes on the videos, which you guys don't really see it, but honestly it massively helps with the YouTube algorithm and putting the videos out there. In the last kind of week and a half, the likes have gone from about 200 down to like 40 or 50, which is a massive drop off, and that's also converted to the YouTube views, and the YouTube views are now down over half at the moment because the like button's not being smashed. So if I could just ask really quickly that you go back to smashing that like button, it really helps push the videos out. I know you guys don't really see it, but just a bit of a, if I can make these videos and spend my time putting this content together for you guys, all I ask is if you could smash that like button. Honestly, you guys won't see it, but it helps massively with the videos getting out there. But we'll take a look at these 3 stocks that I've been buying. And as always, if you want to know what I'm buying and selling in real time, the Patreon is the place to be, as well as 2 exclusive videos a week on there. It is the highest Patreon to subscriber on YouTube. I think that kind of shows how much work I do try to put into that as well. But we'll get stuck into these stocks. So number 1 is Eli, or Callaway Golf. So yeah, this is currently down at $20, and I think an analyst summed it up perfectly in the last conference call. How is the company fundamentally performing so well and the share price is just going lower and lower? That is exactly it. This is a company that at the moment is doing so well fundamentally, and the share price is not reflecting that one bit. Since the 4th of June 2021, so nearly a year ago, we kind of peaked out around that $36 range, and since then we're down 43%, and all that's happened here with this business is the financials have just got better and better, and yeah, it's an absolutely unbelievable golfing company here. Now, the main reason I got into Callaway Golf is because of an acquisition. Previously to the acquisition, I was interested in it. It didn't have as much growth as what I'd like with the classic kind of Callaway golf equipment, the apparel, but then they bought a company that I was really interested in, which was Topgolf. As soon as they bought Topgolf, I was like, okay, this is now where I need to kind of consider buying into Callaway Golf, because with Topgolf, I think the locations are fantastic. I think the activities are bringing the kind of what it brings in for golfers and non-golfers, and then you tie that together with obviously the equipment that Callaway already have. It kind of came the complete golfing company for me, and I think Topgolf is going to be the growth driver for this company in the next few years, and that's already been showing in the last 12 months since this acquisition closed for Callaway Golf. The numbers that Callaway have been bringing out are absolutely unbelievable. Profit-wise, the profit have beaten expectations very much. The revenue as well has been fantastic. It's growing 59% year over year, and even if you don't take the boost of the Topgolf numbers, if you take that out of consideration, it's actually still growing at 30% year over year, which analysts at the moment are actually expecting 20%, I think, growth this year, which is obviously going to be a lot better than what's expected. And as well, the profitability side of it is also looking very good. Callaway also in the recent earnings came out and increased their 2022 revenue outlook, which is fantastic. I mean, in this time of negativity with so many stocks getting killed off, to be finding this company here that is beating expectations on the profit side of it, beating expectations on the revenue side of it, and the outlook has been hyped up, is so impressive. And when you think about this, you'd think that if all these recession fears are kind of going around at the moment, what would be one of the companies that you'd think would get hit quite heavy is Callaway. I'm not going to go spend on them extra clubs. I'm not going to go on that kind of day out or go meet potentially, or we'll go out and spend money at Topgolf. We'll just kind of stay in and do it a bit cheaper, but it's still very much in demand. And this is also off a quarter where we had a bit of the new variant concerns coming in. So actually the first part of this quarter was actually quite weak as well, which is the really scary thing. So you take that into Q2, could be very interesting. And like I said, it is doing so well that Callaway has now announced a $100 million buyback program. This was yesterday, I believe, that this came out. Yes, it is the 26th, just noticed it. They have announced a $100 million buyback program in the shares, basically because the shares are just incredibly cheap at the moment, and management are capitalizing on that, which is a really good positive. And when you look into the financials of the company, I mean, just look at this, if you look at the net revenues, you've got venues growing at a huge amount. Obviously that helps because they weren't in there for the full quarter. Other top golf business lines, same again. But then look at golf clubs. Golf clubs are still growing 17%, golf balls 61%, apparel 42%. And look at the net revenue between regions. You know, you got the US growing massively, Europe growing big, Asia, rest of the world. So this company here is on fire. The company normally has historically some weakness in some area. It's very rare that all the categories at the same time perform this well. And you look at here, it's just a complete golfing business now. The top golf revenues are growing massively. The golf balls, the apparel, it's absolutely on fire at the moment. So in my opinion, Callaway Golf is an easy 2x with this revenue growth. You know, historically this has been a company that grows 3-4%. Now it's going to be growing 10, 20, potentially even 30% this year. The profit might be a little bit up and down as it reinvests into new venues. However, when you kind of consider that, you know, that's investing for future growth, that will be paid back very much in them top golf venues. It's incredibly exciting. Financial health-wise, it's not too bad either. It currently sits around about a 35% debt to equity, which isn't too bad. And when you look at the insider buying, there's been a bit of insider buying recently going on as well, which is really positive. So yeah, I'm a big fan of Callaway Golf. I've been thinking about giving it its own video on YouTube at some point, but yeah, really good earnings and very cheap shares as well. Next one, of course, I bought it, the King. I bought the King. It's coming down at $14. It's off its 52-week low slightly. If we can see here, really around about this May time, it has had a bit of a big bounce up here, which is good. But ideally, if it can stay down here a bit longer, that'll be great, so I can accumulate more shares as much as I can. Because at 6 billion market cap, I think this is fantastic. I think we'll talk about DraftKings, where in the next 5-10 years, this will be 100 billion market cap. Now, the growth from DraftKings basically comes that online sports betting is currently not allowed in the US. It's only just starting to be allowed. This is very much a brand new kind of growth area, and if you're from the UK, you'll know that this is going to be very successful. And I think DraftKings will take around about 30% of the market, or 20 to 30%, split between them and FanDuel. They'll take the other 20-30%, and then the rest will be made up of like smaller players. But I think DraftKings will take a really big chunk of this online sports betting side of it. Now, there's a lot of states that are still to come online. There is a massive increase at the moment, but this is still really early stages. And when these states come online, there's a little bit of an expense to kind of getting launched, you know, do the marketing campaigns, join us and you get so-and-so free bets. However, the great thing about a lot of these states at the moment, these states are coming more and more profitable. Like, the margins on them are fantastic. It only takes 2 to 3 years for these states to come profitable. And also, when these states come profitable in 2 to 3 years, these states still grow at like really good rates. Like, you're talking like 30% revenue growth. So even when DraftKings kind of matures, let's say in like DraftKings matures in the next kind of 5-10 years, it's still going to be growing massively. And then also, because all these states in the next few years are going to start contributing profit, it's also going to be a profit beast in the next few years, which is so exciting. So this is definitely one of the stocks that I'm in for a really long-term hold, because it has such a long runway, because this area has only recently come online, but it's very exciting, and I'm a big fan of DraftKings. If you look at the recent earnings, once again, unbelievable earnings. They adjusted their losses as well, and they also had an increase in the revenue side of it. They beat expectations. Very good from DraftKings. So it had basically no reflection in the share price, as you can see, the reported earnings, and then you can see this downtrend that happened here, which was so unjustified because these earnings were quality. It is funny now that it has started rebounding since them earnings, but the earnings were honestly 10 out of 10, and that's all DraftKings has done since it's come on through a SPAC. It's smashed its earnings. Let's not forget, right now, DraftKings should have been doing like 1.3 billion in revenue. 1.3 billion in revenue. We potentially talk about DraftKings doing like 2.3 billion in revenue by the end of the year, and the profit as well, like the profit side of it in the longer term is just growing and growing, and the TAM's growing faster than what we expected, and it's down at 6 billion, which is just absolutely crazy. It has recently launched its sportsbook in Ontario as well, so that's something to keep an eye on and see how that growth goes. So basically, it's not just a US company now, it's got US and Canada, which is great, and as well as that, it has acquired GNOG, so it'd be very interesting to see how GNOG goes in the next coming few months, and if that changes the outlook at all, which I think are two really good acquisitions. So yeah, DraftKings on absolute fire at the moment, and while the share price is disrespected and putting it back down to like SPAC prices, even though the business is nowhere near where it was 2 years ago, I am buying shares as much as I can in this one right now, and that's probably why you've seen me mention it so much on the channel. Next up, the last one, which is a big blue chip, which is PayPal. PayPal at $80. I never thought we would see this day. I mean, we talk about PayPal like it's had so much benefit from the CV situation. And we talk about PayPal not even like pre-CV prices. We're not talking about prices that it was at in 2019. We're talking about prices that PayPal was at in 2018. We talk about PayPal is now priced at what it was 4 years ago, which is just unbelievable to see. And I am buying this big blue chip massively because I think it still has so much potential in the next few years. And let's just look at the past performance. This has a proven track record of growing the revenue and profit. Like we said, the stock is currently valued at 2018 levels. I mean, let's just have a look. Let's go mid-2018. Let's say June 2018. The company was doing 14 billion in revenue, and the company currently has just done 25 billion in revenue and 3.5 billion in profit. That is how unbelievable it is. You know, this is nowhere near the same company it was in 2018. And I guess the main thing is, well, why is the share price dropping so much on PayPal? Well, the reason why is because it's had a bit of an outlook cut. It's struggling with a lot of the problems that are currently going on in the world. It got some hard quarters because of eBay and not using its service on eBay anymore. However, when you do look at the company, it's going to take a little bit of a hit on profit. The revenue is down a little bit more than what we expected. We expect, high teen growth, and it's going to be 11-13% growth. So that's obviously the hit in the short term. However, when you look at long term, it's still going to easily grow 10+%. And I think it's going to go back to high teen growth, and the profitability will start ramping back up in this one. And you can see that analysts are actually expecting the same thing as well. It's going to take a bit of a hit this year, but then we're going to start rebounding going forward. And when you look at this company right now and the value that it's at, it's unbelievable. Like, PayPal is currently priced that it's going to stay down at these levels forever. And it's not going to grow at the previous rates it has done. It's going to stay down growing at 10%. The profit's only going to grow, around about 10% a year, which just isn't true. And I think PayPal at the moment I originally bought at PayPal and I thought, you know what, in the next kind of 5 years, I'm going to double up my money. Now that PayPal's down at $80, I'm trying to look at PayPal going, rather than doubling my money, I think I'm going to triple my money in this investment in the next 5 years, which just is insane to see. And the great thing with PayPal as well is that actually at the moment, there's a lot of insiders buying, which is a really, really positive sign. And when you look at PayPal from a historic metric point of view, look how cheap it is. Total enterprise value to revenues is a 3. It's never been a 3. Like, the lowest it's been is like a 5, and that was in the CV crash. If you look at total enterprise value to EBITDA, it's currently a 14. Same again, it's never been a 14 before. Even at peak CV, it was a 19, which is just insane. So whichever metric you want to look at, PayPal is historically very cheap right now. And as well as that, I think the business is still very strong and will do very well going forward. So those are the 3 stocks that I'm buying at the moment. I will continue to buy them stocks in particular while they're down at these sort of valuations, and I'm a massive fan of all 3 of them. So yeah, hope you enjoyed the video. Hit the like button. If you want to let me know in the comment section what you've been buying, I'm always interested to know, and I'll catch you on the next video.